Hello, this is Dr. Paul Cottrell, and I want to talk about the market and what is going on in the United States and what the Federal Reserve is signaling to the market participants and how this is going to affect your retirement savings trading portfolio. So let's dive into the announcement by Chairman Powell, who runs the Federal Reserve. There's a chairman, and then there are different presidents of banks that sit on the council at the Federal Reserve. I believe it's 12 banks, and they discuss monetary policy. Now, the Federal Reserve has a dual mandate, and that is full employment and control of inflation. Now, full employment moves around a little bit, but on average, full employment is around 5%. But that is a broad brush. Sometimes it's a little bit more, sometimes it's a little less, but on average is about 5%. We've been running at about 3.7, 3.6% unemployment for quite a while. So from historical trends, we actually have a heated job market. All right. That's assuming historical trends. All right. And maybe something is changing in the economy. But a lot of times when people say this time is different, usually that's right before the crash happened. So let's assume this time is not different. So we have kind of a heated job market, even though we have individuals doing the Great Resignation, right? There's a lot of people that are exiting because they can't exit. Some people are retiring earlier because they did well on the market or whatever the reason is. Some of it is the pandemic. But what Powell signaled at Jackson Hole, Wyoming's economic conference was that there was going to be, quote, pain to break inflation. So in the United States, we've been having an inflationary spiral for a better part of the Biden administration. A big part of that is his demonization of money, of the oil markets. All right. And then the money printing that has been taking place by Congress for all the stimulus that's been happening for the last 2 years or so. So we have kind of an inflation spiral, and the Federal Reserve is trying to break that. Because there is a little buffer between 5 to 3.7% unemployment, the Federal Reserve thinks that they could create pain in the market. Now, some of the economists and the representatives from the banks that are part of the consortium for the Federal Reserve, their estimates are that you're going to have maybe 4% unemployment, 4.2% unemployment, but they're not saying 5 or 6 or 7, right? So I kind of think that their guidance, their economic prediction on unemployment is actually way too low, and that unemployment is probably going to be higher than natural unemployment as we try to break the spiral. I think Larry Summers is also thinking the same thing. He's an economist. He used to be a Treasury secretary. He wanted to be the head of the Federal Reserve, and he's not a likable guy at times. I've actually met Larry Summers at INET during my PhD days, and shortly after my PhD, I went to different conferences around the world that was tied to INET. This was the organization that George Soros created. So I had an opportunity to talk to some of the largest minds in economics over the years that I participated in INET. Then I went into medical studies and kind of went away from that whole crowd. But the main point here is that the Federal Reserve is signaling for pain in the market. All right. That means unemployment. That means raising the rates. The Federal Reserve will continue to raise rates until it breaks inflation. And as you raise rates, companies that need to borrow or refinance, it's going to get harder and harder for them because the rates for refinancing or for borrowing will start to get too high to the point where they'll cancel projects. In addition, we have, as people spend less because of inflation, there's going to be this kind of like decreased demand. Companies see that decreased demand. They start cutting employees. You're starting to hear it in the news. Apple is saying that they're going to lay off people. Google is saying that they're laying off people. People that are in tech that have been trying to do VC. I know a lot about the VC world, right? Venture capital world, because I live in New York, right? And deals are being put on hold or are being canceled. Well, that's a sure sign, on top of IPOs being postponed, that's a sure sign that the market is going down. All right. So as an investor, what do you do to be able to benefit and not get hurt by this? All right. There are two broad types of investors: active investors and passive investors. There's kind of a pseudo-passive investor too, but I just want to put it in two simple camps. If you are a passive investor, where you normally just buy like you're investing in 401k, or you're managing your own portfolio, but you're just, buying very passively the S&P 500, or maybe some sort of bond fund, an ETF bond fund, or you have a 401k and you're buying mutual funds within the 401k, and you're maybe a 60-40 split, 60 in equities, 40 in bonds, whatever it is. What I want you to do, because the market is going to start going down, I personally think that the most prudent strategy is to put your money in cash or a money market. Some 401ks, you can't put it into cash. They don't have a cash account. Sometimes they do. But if you don't have a cash account, put it into a money market and keep it there and let the market burn down. All right, let the market start to collapse. When you start seeing the upturn of the equity market, all right, usually the upturn in the equity market will happen before the recession and all the unemployment starts to abate, because it's always forward looking in the market. So get out of your positions, put it into cash, and hold it, and wait until the big 20% drop. All right. Once you start seeing the market start to move a little bit up, because we've had 2 weeks of poor performance on the S&P 500. So, and this is going to be a downward trend. In the news, you're going to start hearing more and more unemployment. You're going to start hearing about, people may be defaulting on mortgages and blah, blah, blah. All right. But if you take the money out, you aren't going to feel that pain. All right. And then when the market is starting to come back up, then you redeploy that money into what you feel comfortable based on whatever your situation is. If you're younger, you probably want to put more weight on equities. If you're older, you probably want to put more weight on bonds. But if you really want to gain a return, if you take the cash that you have and put it into a equity ETF or equity mutual fund, like an S&P 500 kind of thing, you're going to see a big gain. So the market comes down. So you bring it in, you bring in your cash. The market comes down 15, 20%, depending on when you pull this out. And then when the market starts to come up, you redeploy your cash into the equity, and then you get that rise. So when it reaches par from the high of when you pull the money out, you've gained 20%. While everyone else that stayed in the market is now break even, and they didn't capture that fall. So pay attention to what I'm saying. Believe me, I know what I'm talking about on this. So That's for the passive investor. Now for the active investor, this is the type of person that has their own portfolio, through maybe TD Ameritrade or, through some other broker, and they actively trade. Maybe not high frequency trading, but they're actively trading. Maybe they do a few trades a day or a few trades a week, but they're actively trading, right? Well, you can get into the equity. You can follow my advice and just do this passively. Or if you want to be very active about it, you can start using the S&P 500 short ETFs and start purchasing short positions in the ETF. If you're a more sophisticated trader or investor, then you can start getting into the option market. You can buy puts, and then your options will start to increase in value. You can sell calls. The market's going to go down, and if you sell a call, the person that's buying the call thinks that the market's going to go up, and as the market goes down, you make the difference. So there's a lot of different ways to play this. Play it in the ETF, long short type ETFs on the S&P 500, and another way to play it is the option market. Now, if you want to play the oil market, you can start going into looking at Gush if you want to long positions, or DRIP if you want to short positions. Now, my take on oil at the moment, I don't have any oil positions currently, but I rode up that wave when oil was skyrocketing. This thing is going to continue to go down. So if you're an active trader, you probably want to go into DRIP. And that's an ETF that's leveraged, and but if you're going into a leveraged fund, then you know that there's higher risk. And that's another point that for the active traders, you can play it where it's when you're shorting the S&P 500, you can just, it could be 1x, 1 for 1, or it could be leveraged, 2x or 3x. So it just depends on your risk tolerance. That's what I think is going to be going on in the market. I think that the market is going to continue to go south, and that if you listen to me, if you pay attention to what I'm saying, you're going to fare way better by putting cash on the sidelines. If you're a passive investor, putting cash on the sidelines and wait it out. Don't chase the market. There may be some head fakes where you may have a couple days or even a week where you have positive returns in the S&P 500, and then all of a sudden it comes back down. Just be patient. Now, this patience of keeping cash on the sidelines for the passive investor could be anywhere from 3 to 6 months. All right. But if you listen, you're going to gain 20% return when you redeploy. And it will take a couple of years or a few years for the ones that kept the money in the market to break even. While when you've redeployed in a year or two, you have increased the value of your portfolio. This is how you get wealthy. It's not constantly putting money into a fund and blindly just do it. It's to understand that you have these moments in time where there's a big sell-off. And if you put it cash on hand, and when there is this uptick, this upturn in the market, then you benefit from that upturn instead of digging yourself out of a hole because you didn't move it into cash or a money market. That is how you do it. Now, for the ones that are crypto, play the crypto game, I personally think that the Federal Reserve is going to be going digital dollar. It's not going to be tomorrow. They're going to leverage the blockchain technology that's out there, and that infrastructure that's being built. But they're going to move to the digital dollar. That means that the cryptocurrency markets are going to be less, like Bitcoin or Ethereum or Doji, or whatever the currency is. If you notice, Bitcoin, I believe, is at 19,000. It's deflating, right? So, and as the Federal Reserve keeps on raising rates, it's actually strengthening the dollar. So when the Federal Reserve and the Treasury starts to move towards a digital dollar, it's probably going to be gradual. I don't think it's going to be an instant thing. And we'll still have cash, but then eventually they'll collect the cash and coins, and that will be done. And then it'll be more of this digital dollar. This is probably going to take until probably 2025 or 2026. I don't think that this is like right now. But as this starts to gain momentum, and you hear it more and more in the news, I think that the value of these Bitcoin, cryptocurrency type investments are really just derivatives, and that there really isn't any true backing of this, and that countries, because what is a country? You control your borders and you control your currency. So the premise that Bitcoin is going to be a safe haven for value is erroneous. The Federal Reserve is either going to make these other currencies illegal, or they are just going to be virtual derivative markets that really don't hold any true value. If someone said, I'm going to hold true value in a currency, but you have a lot of volatility in that currency, by definition, economic definition, that currency that has the high volatility cannot hold value. You want low volatility to hold value. So everyone that thinks that crypto is the savior of some decentralized, get away from the government thing, you don't know what you're talking about. You didn't learn economics. You don't know finance. But what the thing is that you have big players like BlackRock and other, like Goldman Sachs, that are creating funds that are tied to the crypto market. And they are hoping for a big payout day. And they don't care if the whole system crashes, because the Federal Reserve says this is no longer legal tender. But stay away from it. If you're in it, get out now. All right, just stick with real economics and not this virtual economic bullshit. It's the same mentality. They think crypto is going to be a safe haven and a holder of value, but yet it's so volatile it can't hold value. If you're a business and you want to transact in crypto, you don't even know what the value of the product that you're selling is, because it changes by the day. That is how countries failed, because they had instability in their currency market. Again, people that invest in crypto don't understand history. So take it from me, just stay away from it. But there will be this move toward the digital dollar and the Federal Reserve, and then there's going to be a surveillance. There's going to be a surveillance of your transactions through this. But I don't think that is tomorrow. I don't think that is even in this administration. This is probably going to be after 2024. So that's my take on it. Please subscribe to all my channels. I have 3 channels on YouTube. All the links are in the description of my videos. Please subscribe to those. Please also subscribe to Brighteon, Bitchute, and Rumble. This way, anything that is censored by YouTube or I have to self-censor, you can still see on those other 3, Bitchute, Rumble, and Brighteon. Please go to Patreon and support my work. It's for a nominal fee. You'll see the same content that I'm posting on the other, but this is a way that you can help support my work, especially the international viewers that can't purchase the products that I have because of the shipping costs to other countries is way too high for individuals to afford. So please go to Patreon and subscribe that way. Please go to my website, the-studio-reykjavik.com, and donate. You can donate through Stripe or PayPal to help support my work. I've covered a lot about a lot of topics here. If you have $100,000 in, let's say, the market, all right, and you pull it out and put it into cash or in a money market, and you wait it out, you will make $20,000 in a year or a year and a half, all right, when you redeploy that cash and the market goes back up to par. While everyone else that stayed in the market is still at $100,000 a year and a half after the crash. that little information that I just put in this video is worth a donation on Stripe or PayPal. Or better yet, go to my store, the-studio-reykjavik.com, and please, please look at the health products that I have. I have a lot of anti-aging products, and I have also curated different boxes, what I call anti-aging boxes, or I created this anti-Fauci box, where the whole premise is that you neutralize pathogens with nanosilvers, you reduce inflammation with turmerics and ashwagandha and the like. I have a lot of supplements that are good for your health, and I have a supplement, it's a C60, in avocado or coconut oil, that will neutralize ROS, reactive oxygen species, and boost up your mitochondria, boost up your ATP. And by boosting up your ATP, you're going to have more energy and you're going to have a better immune system, and you will age slower. And if you have a chronic situation, you most likely see it start to revert. So please support my work by going to my store, the-studio-reykjavik.com. All the links are in the description. And thank you for staying with me and hearing my take on current events. Have a nice day.